If we have a big company and this big company buys a 30% stake in company A, then this is referred to as an investment in an associate company. To put it more formally, an investment is considered an associate company when the investor, in this case big company, has or can exercise significant influence but not control over the investee's business activities. Here the investee is this company. Generally, it is presumed that if the investment is somewhere between 20% and 50%, then there is influence. In fact, there is significant influence, but there isn't control, because generally for control, a 51% or greater stake is required. Other than this general ballpark of 20% to 50%, there are other items which can suggest the fact that there is significant influence, and those items are shown here. Representation on the board of directors, in other words, they are representatives from big company who sit on the board of company A. Participation in the policy making process, material transactions between the investor and investee, interchange of managerial personnel, and technological dependency. So if these or any of these hold, then that would suggest significant influence. Another categorization is joint ventures. This is where two companies, say A and B, jointly run a certain operation. So for example, A is a company that is based in another country. It comes to India and sets up a joint venture with company B, which is based in India. With a joint venture, there is a contractual agreement between two or more parties, and when two or more parties form a joint venture, each party is referred to as a venturer. The second characteristic is that the contractual arrangement establishes joint control of the entity which is created. The important aspect for this reading is that both for investments in associates and for joint ventures, the equity method of accounting is required. And over the next few slides, we will understand the equity method in detail. To understand the equity method, let us consider a very simple example. Let's say we have big company again, and this big company buys a 20% stake in company X. Say that X is worth 100,000 and a 20% stake then is worth 20,000. So the investment made by big company is 20,000. Big company will show an investment of 20,000 on the balance sheet, and this would be classified as an investment in an associate company. Let's say that during the year, company X has a total net income of 100. What big company will do on its income statement is show its own share of income, not the dividends. If the total income for X was 100, then 20% of 100 is 20, and this is the number that will be shown on big company's income statement as income coming from the associate. Investment account reflected as a single line item on the balance sheet. All this means is that on big company's balance sheet, we will just have one line item which represents the investment in X. Value of investment is beginning value, which in my example is 20,000, plus the share of profit, and in my example the share of profit is 20, minus share of dividend. Let's say that big company, being an investor being a shareholder gets a dividend from X, say the value of that dividend is 5, then the overall value of the investment at the end of the year will be 20,000 plus 20 minus 5. The reason we have minus 5 here is the amount of dividend then goes and increases cash. So if we did not subtract this over here, then they would be double counted. In terms of categorization or classification, the investment is shown as a non-current asset on the balance sheet. And as you can see, this is one line consolidation. The value of the investment is shown as a single line on the balance sheet and as a single line on the income statement. Take a look at example 2 now in the curriculum, and I want you to solve this before looking at the solution. Here is what you need to do, and we will consider what happens in 2010. The initial value shown on the balance sheet on 1st January 2010 would be 200,000. That is because we are told here that 20% of the interest in Williams is the associate company. Branch company is the big company which is buying a stake in Williams. The amount being paid is 200,000, so that's our initial amount. Then in 2010, Williams has income worth 200,000. We take 20% of this, which is 40,000. So Branch's share then is 40,000, and this is called equity income. But Branch then receives a dividend of 10,000, and this 10,000 is 20% of the overall dividend. This is subtracted from the value of the investment because this 10,000 is going straight to cash. At the end of 2010, therefore, the value of the investment is 230,000. We follow the same logic for 2011 and 2012, and if you do this right, then at the end of 2012, we will have this number on the balance sheet. In the previous example, we assumed that the purchase price is equal to the fair value of the assets. But that is typically not the case. When you have a company, let's say big company in this scenario, buying a part of another company, typically the amount paid exceeds the book value. In fact, the amount paid might also exceed the fair value. And let's look at a scenario here. Big company buys 25% of an associate company. For simplicity, we'll just call this company associate company. This associate company just has one asset, so it is a single asset company, and the book value of that asset is 100. The fair value is higher. That fair value is 120. But let's say that associate company has a loyal customer base, and because of that, the actual value of the overall company is 160. If big company is buying 25% of the associate company, this 25% would be 25% of 160. So the amount paid would be 40. But this 40 has three different components. The first component is the reported net asset value of the investee. The reported net asset value of the investee, which is associate company, is 100. 25%, which is big company's stake, would then be 25% of 100, which is 25. Then the next component is the fair value surplus or deficit. What does that mean? Obviously, the amount paid by big company also covers the cost related to the fair value of the assets. The difference between fair value and book value is 20, and 25% of 20 is 5. So part of that 40 is the excess amount paid above book value. And then the rest is goodwill. So 25 is the reported net asset value on the investee balance sheet. 5 is the additional amount because when the numbers are reported on the big company's balance sheet, we need to consider the fair value of assets. So that is explained by the 5, and then the rest, which is 10, is goodwill. There are two ways of seeing where the 10 comes from. One is to simply say 10 is the difference between 40 and 30. The other way is to recognize that total goodwill is 40, but big company is only buying 25%, so 25% of 40 is 10. Another subtle point here is that this surplus of 5, which represents the difference between book value and fair value, needs to be amortized over here on big companies' financial statements. The amortization of the 25 will automatically happen on the books of the associated company. Let us now look at example 3 from the curriculum, and I want you to read this and do it first before looking at the solution. Here is how I would solve this problem. The amount paid is 100,000, and if you recall from the previous slide, this 100,000 can be broken into 3 components. The first component is the book value on the investee's balance sheet. That number is 220,000, but we only take 30% because that is the stake which Blake Company has. 0.3 into 220,000 is 660,000. The next component represents the amount of fair value which is in excess of book value. The difference is 270,000 minus 200,000, which is 50,000, and we need to take 30% of 50,000, which is 15,000. And then the third component is goodwill, which is a plug. The total amount paid is 100,000. Subtract these two numbers and you get 19,000. So this is the amount of goodwill. Now we will look at example 4, which gets into a little more detail. You will note in this example that excess amounts allocated to identifiable assets or liabilities of the investee must be amortized on the investor's balance sheet, and we've alluded to this earlier. Again, I want you to try this first and then look at the solution. Here is my solution. So 500,000 is the amount paid for a 30% stake. Here are the 3 components. The first component is 30% of the book value. The book value is 120,000 and 30% would be 360,000. The second part reflects the difference between fair value and book value, and then we take 30% of the difference. The difference between fair value and book value is 300,000. 30% of 300,000 is 90,000, and then goodwill is a plug. It is 500,000 minus these two numbers. So goodwill is 50,000. In part 2, we want to determine the investment in the associate at the end of the first year. That number is 506,000. How do we get to this number? We start with the purchase price. So this is the investment in the associate at the start of the year. Then we add the share of net income. The overall net income is 100,000. The investor's share is 30%. 30% of 100,000 is 30,000. And then we subtract the dividend received. The dividend received by the investor is 15,000. That number is subtracted. Up to this point, the working is similar to what we have seen in a previous example, but this line item is different. The reason is that the amount paid is above the book value, and the difference between the book value and the fair value, that number has to be amortized over the useful life of the net assets. We are told that the useful life is 10 years, which means that this excess amount of 90,000 needs to be amortized. Each year, the depreciation or amortization is 9,000, so that number needs to be subtracted. When this is subtracted, we get 506,000. So this is the value of the investment in the associate at the end of the year. This bullet point deals with the fair value option, which is described in section 5.4. Both IFRS and US GAAP give the investor the option to account for their equity method investment at fair value. Under US GAAP, this option is available to all entities. However, under IFRS, its use is restricted to venture capital organizations, mutual funds, unit trusts, and similar entities, including investment-linked insurance funds. This is fairly self-explanatory. The next bullet point has to do with impairment. Both IFRS and US GAAP require periodic reviews of equity method investments for impairment. If the fair value of the investment is below its carrying value, and this decline is deemed to be other than temporary, an impairment loss must be recognized. There are a few more details related to IFRS and US GAAP. Under IFRS, there must be objective evidence of impairment as a result of one or more events that occurred after the initial recognition of the investment. And these events should have an impact on the investment's future cash flow, and that impact should be measurable. Also note that with IFRS, the goodwill amount is captured in the investment amount which is reported on the balance sheet. If the number reported on the balance sheet, which is called the carrying value, is higher than the recoverable amount, then we need to impair. And to impair, as indicated over here, the book value is written down and the impairment is shown as a loss on the income statement. US GAAP employs a different approach. If the fair value of the investment declines below its carrying value and the decline is determined to be permanent, then US GAAP requires an impairment loss to be recognized on the income statement, and the carrying value of the investment on the balance sheet is reduced to fair value. Let's say that the investor has business transactions with an associate company. Either the investor could be selling to the associate, this would be called a downstream transaction, or the investor could buy from the associate, this is called an upstream transaction. How do we account for these transactions? Because an investor company can influence the terms and timings of transactions with associates, profits from such transactions cannot be realized until confirmed through use of a third-party sale. What this means is, if the investor sells 100,000 worth of goods to the associate and there is a profit, let's say, of 20,000, this revenue and profit cannot be booked immediately. Only once the associate sells to a third party, can the revenue and profit be recognized by the investor? And the same principle holds true with upstream sales. If an associate sells to the investor, the equity profit shown by the investor cannot include this sale until the investor has actually sold to a third party. And that is stated more formally over here. The investor company's share of any unrealized profit must be deferred by reducing the amount recorded under the equity method. This deferred profit is added back to the equity income when confirmed. Let us now look at example 5, which deals with an upstream transaction. And I want you to do this first before looking at the solution. Let's do part 1 first. Here we have an upstream transaction and we need to figure out the reported income on Wicker's income statement. Wicker is the investor. The starting point is 5,000 because the associate company has a net income of 20,000. This is given, and Wicker has a 25% stake. 25% of 20,000 is 5,000. This is the starting point. And then we need to back out the amortization number. The amortization is associated with the difference between fair value and book value or carrying value. That difference is 10,000. But this difference needs to be amortized over 20 years. When we do that, we get an amortization expense of 500 per year. So that needs to be taken out. Plus we need to back out the impact of this profit, since the associate company sold to the investor and the profit was 8,000. 25% of this, or 2,000, is included in the net income. But since the sale has not yet been made to a third party, we need to subtract 2,000. So the reported income is 2,500. Now let's look at example 6, which deals with a downstream sale. And again, I want you to try this first before looking at the solution. Here is what we need to do for part 1. The starting point is 200,000 because the overall net income for 2011 is 800,000. We need to take 25% of 800,000, which is 200,000. Then we subtract the impact of amortization, which is 8,000. That number is given. We also need to subtract 4,000 because of the unsold inventory. And let's take a look at how this 4,000 is calculated. It is given to us that Jones sells to the associate company, which is Jason. The profit from the sale is 640,000. The selling price is 160,000 and the cost is 96,000. The difference is the profit of 64,000. We are also told that of the amount that Jones sold Jason, 75% is sold to third parties, which means that 25% is unsold. So the amount that we need to back out is associated with this 25%. Remember also that Jones company owns 25% of Jason, and it is purely a coincidence that both these numbers are 25%, which means that in this number of 200,000, we have 16,000 which can be explained by this number. 25% of 64,000 is 16,000. Of this 16,000, 12,000 is okay to recognize because 75% of this number has been sold to third parties, whereas 25% or 4,000 has not been sold, and this amount is what we back out or subtract over here, and we are left with equity income of 188,000. Now try part 2. Part 2 is quite simple. Our starting point is 205,000, which is simply 25% of 820,000. We subtract the usual 8,000, which is the amortization, and then the 4,000 that we subtracted in 2011 is now added back because this amount is actually sold in 2012. So the equity income is 201,000 in 2012. Under both US GAAP and IFRS, companies must disclose the assets, liabilities, and results of equity method investments. In other words, even though we have one-line consolidation on the balance sheet and the income statement, but the details associated with the assets of the associate company, the liabilities of the associate company, and the operating results, these need to be shown in the footnotes. We also need to look at some issues that analysts need to be aware of when using the equity method. One of the first questions or items an analyst should look at is whether the equity method is being used appropriately. The high-level guideline is that if the ownership stake is between 20% and 50%, then use the equity method. But an important point is related to significant influence versus control. It is possible that an investor owns 40% of a company and is by far the largest shareholder and hence has control. But because the equity method gives better ratios, as we'll talk about shortly, the investor might still choose to report using the equity method. As an analyst, you would consider that a major red flag. So keep in mind that you need to determine whether there is significant influence or control. If the investor has control, then the equity method is not the appropriate method to use. As we've said several times, the equity method is effectively one-line consolidation, and because of this, profitability ratios tend to look better. If you take this simple ratio, net income over revenue, which is the net profit margin, the net income is increased because we are taking the proportionate share of net income from the associate and increasing our net income, but we do not change the revenue number. So if the revenue number is the same but net income is higher because of the associates, then overall the ratio will be better. Also, debt ratios will be understated because on the balance sheet we increase the asset number by bringing in the net asset value of the investee or the associate company. We do not bring over liabilities. So if you have a situation where the total assets are 105 million and total liabilities are 100 million, then the effect that is brought over is simply 5 million. We do not even consider this 100 million number. So the debt ratios will also look better with the equity method. And finally, as an analyst, you need to look at the quality of earnings. The equity method assumes that a dollar earned by the investee is a dollar received by the investor company. If you recall, on the balance sheet, what we do is take the initial purchase price and then add the proportionate share of net income. Let's say that the associate company is paying no dividends, then the balance sheet number goes up by the net income amount. Even if the associate company has no intent of paying any dividends, and let's say the associate company doesn't have the ability or doesn't want to pay the dividends, but the equity method still assumes that this net income amount keeps getting added to the initial value of the investment. So keep an eye on this, because the number going up doesn't necessarily reflect cash being received.